NDAS 8 accounting policy, changes in accounting estimate and error. NDAS 8 specify the criteria for selecting and changing accounting policy together with the accounting treatment and disclosure of changes in the accounting policy, changes in accounting estimate, and correctness of error. So these are the things. What I'll do first, every accounting should have an accounting policy. How you going to account? That is double entry, single entry. Then treatment, accounting treatment. How you follow each and every part of it. I will say. Then after disclosure, what you want to disclose, and disclosure changes. What kind of disclosure changes in accounting policy had happen? You want to disclose. Then if you made some estimate, what are the changes you made that you need to explain. Then after correction of error, some error may happen. That error you have corrected, and this is the error we have done. This is we corrected. That's to be disclosed in the notes of account. These are the things that is to be contained in notes. So India is 8 say what is the accounting policy, what is a change in accounting estimate, and if error comes, how you corrected the error. Everything you should explain here. The statement is intended to enhance relevance and reliability of entities' financial statement. So the financial users should get and appreciate this financial statement. How they can appreciate only when they believe it. The reliability should be there, and whatever the data should be relevant to the previous financial year, and it should be comparable. So that is the important point. In comparability of this financial statement over time with the financial statement of the entities. So always it will be comparable. The disclosure requires a respect of changes in accounting policy. So disclosure require a respect of changes in accounting policy. What is the accounting policy? What change you can say? And out of India AS 8. And other disclosure requirement of accounting policy are laid on India AS 1 presentation financial statement. So what are the others to be disclosed? The India AS 1 has clearly said. India AS accounting policies are specific principle and basis and convert rules and practice applied by the entity in preparation and presentation of financial statement. So how to prepare the financial statement one, how to present it uh, to not only this presentation and preparation, how to prepare, how to present, what are the basic principle, basic conveyance, or basic the rules, what are the basic practices. That is also to be the part of the accounting policies. The select and application of accounting policy. What are that? In the case of specific NDAS exists, the accounting policy can be determined as per the applicable NDAs. How? In case of no specific NDAs exists, there is no specific NDAs for this company now. Management shall use judgment to develop and apply accounting policy that result in the information. So there is no specific NDAs now. They need to develop it as per the IFRS. That is the thing. And they need to apply this NDAs, which is relevant to economic financial decision making needed for the user. Economic, na, international and domestic investors requirement. Reliable such as financial statement. So what we research and what we present this financial statement when there is no NDAs is applicable to this company, that is completely reliable. Even international standards should apply. Represent actually the financial portion, financial performance and cash flow of the entity. Reflect the economic substance of transaction, how this transaction has been accounting, all the accounting policy are proper. Everything to see. Other events and conditions, not merely a legal form. So some events are going to happen. So contingent liability should be considered. Contingent asset should be there. So based upon the events, how this contingent asset, contingent liability has been properly accounted or not, you can should see. Or a neutral with a free from bias. It is not biased. It's not biased. It should be neutral or prudent. Prudent concept should be accepted. Prudent means what? Accrual concept is when the income accrue, what the income accrue, only we will do. Expense accrued. We going are going to be expensed அப்படின்னா we will consider that expense. In prudent concept, even that is a remote possibility. It's a remote possibility of income to be considered, then we will consider it as a income. If not, there's no income. So whatever the income what we are saying, it is actually income. It's not some kind of fake. Because accrual concept is always says mostly says about expenses. But prudent says a relevant income or complete of all material aspect. It should be complete of all material aspect. Nothing should be left out. Everything should be accounted. Everything should be represented properly. In making the above judgment, considering the following sources of following descending order, you should consider this in descending order, larger to smaller. Requirement of NDAs dealing with similar and related issue. You should consider NDAs. How should you consider NDAs? You should see what are the similar aspects you see in NDAs and related issues in these. You should resolve it and you should apply it. Definition, recognition criteria, measurement concepts of assets, measurement concepts of liability, income and expenses in the framework. This to be considered. The most recent pronouncement of International Accounting Standard Board and in absence therein, there are other standard setting boards that are similar conceptual framework to develop accounting standards and other accounting literature and accepted industry practice to extent that do not conflict with the above mentioned resources. So you should read what you need. International Accounting Standard Boards, accounting policies, journal you should read. Any new amendment we got into new NDAs, you should apply that. That is the only way of doing this. Okay. Changes in accounting policy. What are changes in accounting policy? Entity shall change the accounting policy only if change it is required by the NDAs. When the NDAs change, you can change. Unless there is a change in NDAs, you are not required to change it. A result in the financial statement providing reliable and more relevant information about the effect of transaction. What is a transaction? How is going to be affect organization that are mostly based on the reliable, relevant information of transactions and events and the conditions of the entity's financial positions and financial performance and cash flow. Even though we provide proper NDAs, the NDAs is effectively applied only based on the company's events, transactions, entity's financial position, cash flow. And these are the events that affect the NDAs indirectly, vice versa. So accounting change in accounting policy, initial applicability, then transition provision exists above. Then as per the transition provision. Second, initial application of India. So transition provision is not applicable or retrospective. From the starting to end, you should the current state you need to change it. It's voluntary change in accounting policy, not retrospective. It's not as per the transition provision. Wow, from the starting you need to change. So it's best to accept the NDAs from starting. Any company they can follow NDAs that is well and best. And changes in accounting policy shall be applied retrospectively, except to the extent that is impracticable to determine either a specific periodic specific effect or cumulative effect changes in effect. A specific event, cumulative effect, it change. You should see. The standard clarifies the initial population of the policy to relevant assets to assure that NDAS 16 property, plant and equipment and NDAS 38 intangible assets and changes in accounting policies are dealt with revaluation according to the NDAS 16 and NDAS 30 rather than according to NDAS 8. So there is one conflict on what NDAS 8 to 16 and 38. NDA 16 is plant property equipment, but NDA 38 is intangible assets. So you want to reevaluate across accounting policies. Sometimes what you want to do, you want to reevaluate them, according but you may think you want to do as per India AS8, but no, you should do the accounting evaluation only based on the specific India 16, India 13, rather than focusing on India 8, because the specific standard for specific party, specific assets, or specific assets in this case have an higher, higher compatibility than lower Indies. So, of seeing this, only India 16, India 13 oversees India 8. You should understand. So changes in accounting estimate. How to change affect the change in accounting estimate? The changes in accounting estimate is adjustment of the carrying amount of the asset and liability. So what is the asset? What is the liability? We have a value that we're going to change it to value another value. This has been accounting change in accounting estimate. The amount of specific consumption of the asset. So one asset is there, the asset value is going to change due to its consumption, and the result of the assessment of the present status are expected to benefit future benefits obligation associated with the assets and liability. So based upon the future and past, we should understand the valuation concept and evaluate it. Change in accounting estimate, how to change to be extend related to changes in assets and changes in liability. Okay. So how we extend we going to change it? Second, adjust the carrying amount of asset and adjust the carrying amount of liability, adjust the carrying amount of equity in the period change. In that specific period, you can change. Other changes recognized prospectively in profit and loss of the period affected. So sometimes it is changed only that period. Sometimes the change what may go prospectively affect future period also. So something both affecting future. One is affecting in a single state, one affecting continuously. Prior period error. What is this prior period error? Sir, in the previous financial year, something to be considered, but we felt it. Now in the current year, we are considering it. Okay. This consideration, what we do of the previous consideration, the correction of the previous year is considered in current year. This is called prior period error. Okay. The prior period error or omission from or misstatement in entity's financial statement from one or more period arising from the failure of use, arising the failure to misuse of, failure to use, arising from misuse of, arising from reliable information that was available when financial statement of this period were approved for issue and could realize they expected to have obtained and taken into account in the presentation of financial statement. In the preparation presentation of financial statement, we have left it. So now we need to correct it. Most that is the point. The effect should be correct material prior period errors and retrospectively first set of financial statements approved for issue after being discovered. So where this error should be corrected in the previous year when it is approved and there the effect should be changed. It's a retrospective error correction. Resetting the comparative amount on the prior period presented which the error occurred. So in the prior period where the error occurred, from that we need to change. If the error occurred before the earliest period presented, restating the opening balance of the asset and restating the opening balance of liability and equity from the earlier superior period or center. From the earlier period, from that you need to change. This is what we said. The prior period error shall be corrected by retrospective statement, except to the extent that is impracticable. Determine either the specific period specific effect or cumulative effect or error. So usually the error what we have to see in the past should be done retrospectively. Now, if the error it is not retrospectively can't be done, what you can do? You can take into consideration of what. So this error can't be done there. So cumulatively we can do. What is difference between retrospective and prospective? Retrospective application. It's applied to new accounting policy to transaction, other events and other condition and if the policy had been applied. So this is the year 2025. In the year 2020, we bought into one asset. Thus the asset we be valued this much. Right now, today we have the depreciation of this percentage. Now I'm changing the depreciation of this asset from 10 to 15. So this is prospective because of the usage of the asset today. But the same thing I made in the year 2020 and year 2025. We are evaluating the asset using an one formula we are using. Okay, we applied it wrong. Right now, when we checking, we found that the asset has been undervalued around 1 crore. Real amount. To change that, we need to change the value from retrospectively from the previous year to current year it should come, not from current year to future year. In the retrospective restatement, the correction of the recognized measurement and disclosure of accounts of elements of financial statement or prior period error has been occurred. Impracticable retrospective application or restatement of comparative information. Sometimes retrospective is impracticable, and sometimes a restatement impractical to restatement to comparative information. Yes, the specific period effect changes in accounting policy apply to carry amount of assets and liability as the beginning of the earliest period from the retrospective statement in practical. It is impracticable to restate from the beginning period. And corresponding adjustment of opening balances would be affected and component of equity of the period. And that will affect the equity of that whole period. So we can't do it. So totally difficult, not only difficult, it is impossible. Error. Restating opening balances of asset and liability equity of the earliest period in which a retrospective statement is practicable. Sometimes it is practical, sometimes it is not. In the practicable case, it's error. Impracticable retrospective application and impracticable restatement to comparative information. But in the case of cumulative effects from the period, changes in accounting policy, adjust the comparative information to applying new accounting policy and prospectively from the earliest date of implementation. From this current date, we can do because the India has been applied recently. Here are the restatement of comparative information to correct the error prospectively from earliest date of practical. From this current date, we can do this is the error has been the earliest accounting policy we have followed. From that, we can change. It is impracticable to apply a change in accounting policy retrospectively or to make retrospective restatement to correct an error if. So it is difficult. And the effect of retrospective application or retrospective restatement are not determinable. So it is not determinable certainly. It is based on the events and facts. The retrospective application of retrospective restatement requires assumption about the account management intent would have been in the period. So in this period, what should be there? Based upon the period, the management, what is the intent we need to understand. And then we find the assumption that how are we going to apply it retrospectively or prospectively, or impossible, you need to see. The retrospective application and retrospective statement require significant estimate of amount, and it is impossible to distinguish objective information about the estimate. What is objective information usually? Providing evidence of circumstances that extend on the date or on which the amount has been recognized. So, what is the amount, on what date it has been recognized, you should take and measure, and how it's been disclosed, you should see. And would have been available when financial statement for the prior period are approved for issue of the other information. So, this error, this change, what we made, it should be comparable and it should be mentioned in the notes to accounts. Prospective application, what is it? Change in accounting policy or recognizing the effect of change in accounting estimate, respectively. So we are making a change in accounting policy, then there is accounting STF. If estimate we are changing, that is not going to change retrospectively, but going to be changed prospectively. Applying a new accounting policy of a transition. So the accounting policy from now it is going to transit. And other events and other condition occurred after the date in which policy is changed. So after that, how it's going to change, we should give in the notes. Recognizing the effect of change in the accounting estimate in the current and future product after the change. So after the change, how are we going to do? We should change. See. So these are the part of NDAS 8. Thank you.